Hello everyone, good day to you all and welcome back to another financial session. So today, like I promised, we are going to be exploring how to build healthy portfolio, what portfolio is all about. But before that, I want us to go into listing. When we hear about listing, what comes to your mind? Listing is where the company is officially allowed to share its shares in the stock exchange so that the public can buy and share. So this is when the company is finally put on the NGX for people to buy shares and to sell shares. And a listed company must follow NGX rule. Just like I mentioned, they must be transparent and they must publish financial reports. So this financial report is very, very important. Whenever you want to pick your stocks, you must check their financial reports. You must be sure that they are trusted companies that, your money will be safe in. Now, let's talk about some good sides and the bad sides of listing. To good sides, when it comes to listing, the company will have access to capital or money. Like we said in the other video, that when you buy shares, it's like you are loaning the company, you are giving the company money to do business better. So imagine if 10 people, 50 people buy shares in one particular company, the company will have enough money to add to their business. So that's a good side of listing for the company. And for you as a shareholder, you have ownership. Even students, retirees, they can now have ownership in any company of their choice. I was making a joke about you not being CEO and be bothered. You don't need to bother. Just buy shares in as many as possible companies. The more shares you buy, the more ownership you have in those companies. And also, listing causes financial inclusion. I also have dividends potential here. And finally, shared price growth. Now, let's go to bad side of listing. For everything that has a good side, they always have a bad side. Abi? I don't know if I'm right. Anyways, when it comes to listing, it doesn't guarantee success. The fact that a company is listed and you buy shares from the company doesn't mean that your success is guaranteed. Because in markets, prices can rise and prices can fall. So when prices fall, you might not really be happy about it because it's like you are losing your money. But when prices rise, you'll be happy that you are gaining. So share price can fall, and it can be caused as a result of economic recession, inflation, high interest rates, poor government policy. And another bad side of listing is smaller companies. The fact that smaller companies are riskier. We mostly find these smaller companies under penny stock, like I mentioned. So they can be very risky. As much as your money can go high, it can also come down all of a sudden. So another bad side of listing is company on low bond can rise very fast and go down very fast. I think I just explained that one. And the final one on my list is that a listed company can still be poorly run. The fact that a company is listed doesn't guarantee that they are good. They can still be poorly run. They can have staff that are not running, they are not doing their work efficiently. Ugly side of this is buying without research. You must make your research before you start buying. Ensure that you know the market very well. If you don't understand the business, don't buy the shares. Don't just follow your emotion. Don't follow the crowd. If you don't understand, it's better you give it to people that are into mutual fund to help you invest your money than to invest in what you don't know about. Then I feel like there are some people that always feel that stock always go up. No, stock doesn't always go up. It can go low because even the best football team doesn't always win. They have sometimes that they will lose. So it doesn't always go up. And do not buy shares when the price rise sharply without checking the company's earnings, the cash flow or debt. It's just like you are jumping inside the moving fire. So that's why I say when it comes to shares buying, you can't just follow crowd and say, because people are rushing, they are buying MTN, let me also go into MTN, they are buying Seplat, let me also start buying it. No, when it comes to shares, you can't just follow crowd like that. And you cannot afford to ignore liquidity. There are some stocks that you cannot easily buy, and there are some stocks that you cannot easily sell. You know, when you buy stock and you need your money back, or you do some analysis and you discover that it is time for me to sell this sale, and you want to sell these shares, you cannot share it. How would you feel? So you have to check the liquidity level. Does this share have high liquidity or low liquidity? If it has low liquidity, please avoid it as much as possible. And learn before you earn. Do not expect magic. Stock market is no magic. It is no magic. I believe in miracle, but I don't believe in magic. It is not magic. So please understand the business before you venture into it. And quickly let us move to portfolio. You are hearing portfolio. What does portfolio really mean? A portfolio is simply all your investments put together. All your investments put together. Okay, you buy some cost stock, you buy some value stock, you buy some penny stock, all those things put together. That is what your portfolio means. It's just like your school bag. In your school bag, you have your pen, you have your books. What else do you have? Your eraser, your sharpener, or any other thing you have in your school bag. So it's like the portfolio is like a bag, a school bag that contains every tool or all your investments. Now, one stock alone is on healthy diet. That's what I call it. If you buy one stock, imagine you have 10 million naira and you decide to just invest in one stock. In this digital age, not analog age, gone are those days when people would just enter one company and say, I want to buy shares with you. We are now in a digitalized area that you can diversify your portfolio. You can buy as many shares as possible in different companies. So please don't just buy one stock. Ensure that you diversify. Mixed investment is balanced financial health. Now, let's go to healthy portfolio. The percentage that I want to give you, I'm not saying it is static. It can be subjected to change. You can change it. You can tweak it to your own taste, because we have different type of investors. We have aggressive investors, people that they want to make wealth. People that want to make wealth, they might put larger percentage of their money in penny stock. They are aggressive. And we have moderate risk takers. This one, they want stability, and at the same time they want growth. So they are like in the middle. They don't want their this thing to just go down. So they have moderate risk taker like that, and we have low risk taker. These ones, in fact, most times they don't even go into stock. Some of them, they just fix their money somewhere, like the one that I'm doing, where I'm working presently. So you just fix your money for a period of time and you get a fixed interest. So there is nothing like it might go high, it might go low. It is always on fixed interest. Some go into bond and all of those things that we explained in the first video. So now, for a healthy portfolio, this is my own advice. I will advise that if you're a starter in stock markets, your 40%, the 40% of your money, put it in blue chip. And I believe we know blue chip now. They are large companies that are stable. The companies that that these ones are very stable, like Dangote Cement, GT, NT, all those kind of companies. You can put 40% of your investment in blue chip. Then we have 30% of your investment in dividends paying stocks. All those banks that pay dividends like Access and the others, you can put 30% of your money in dividend paying stock. At least, even if the market goes down, you know that you still get a shared price, a shared interest or shared gain profits at the end of 3 months or 6 months or 1 year. Now, 30% of your money in value stock, and we know value stock, they are like they are the companies that are stable. They are stable, but they are temporarily cheap. Companies like UBA, Dangote, Sugar, and all of that. So you can put 20% of your money in those kind of company. The 10% in growth stock, all those technological driven companies. You can put 10% of your money. So to start again, 40% in blue chip, 30% in dividend paying stocks, 20% in value stock, and 10% in growth stock. You know, I did not mention penny stock. I did not mention penny stock if I starter. And if you don't have the mind, you understand, to risk your money. So don't even consider penny stock. But if you have the mind, you can even buy more of penny stock. You know, the higher the risk, the higher the return. So, and you have to understand is that not every cheap stock is good, and not every big stock is boring. I wrote it here that income beats excitement and knowledge beats luck. So please get knowledge. Get knowledge in everything. Now, what is the power of diversification? You know, I told you to diversify your investments. Diversification means spreading your money across different investments so that one loss will not destroy everything. You know, it's just like when you buy shares in like 10 companies. Let's assume you are buying more than 10 companies, even with small amounts of money. So imagine you buy your shares in like 10 companies. If 2 are not doing well in markets, the other 8 that are doing well will cover up. Most times they will cover up. Let's even say 3 are not doing well and the larger percentage are doing well. You know, you will still be rest assured that your money is safe. So that's why it is good to diversify so that one loss will not destroy everything. So stock reacts differently to inflation, interest rates, and government policy. So that is why you must diversify. There are some stocks that it reacts largely due to largely to inflation. Some will react to interest rate or government policy. So you have to understand this thing and spread your money very well. Now, what are the? Let me just give you one component of a good portfolio. A good portfolio should have core stock of 50 to 70% for moderate risk takers. 50 to 70% of your investment. So the other maybe 40%, 50%, 30%, you can now spread it across all other types of stock. Now, I think with everything that I've mentioned there, I believe you now understand how to invest in stock market. Don't forget that if you have any other question, any addition, anything to ask at all, you can always drop your comments or reach out to me. God bless you. I celebrate you.